Well, our last little bit for today. We actually have a pre-record from Frank Holmes, who everyone knows who Frank is. He couldn't be with us here today, unfortunately, but he's certainly here with us in spirit. So enjoy this pre-record. It's very interesting. Frank Holmes is the CEO and CIO of U.S. Global Investors. And this pre-record presentation is on why Bitcoin can join gold at the alternative asset table. Take it away, gentlemen.
Good day, everyone, and bonjour. And I'm so sorry that I'm in Texas and I'm not able to be to the mining event of the North. And I'm so happy that events like this are taking place. I was in Sweden and I was in Switzerland, but in particular in Switzerland was a junior gold mining conference, which was just packed with family office people, which is so important for this industry. This industry needs some love. And I'm going to walk you through and explain Bitcoin mining to the best I can in a quick few minutes, along with gold mining, the similarities, the differences. But what makes the crypto ecosystem so unique and different, and where gold can learn from the crypto ecosystem. So let's get started here. Before we talk about the sort of the safe harbor, is all about volatility. And when a company makes a presentation, really a lot of it deals with what can move a stock. And it's important to recognize that gold is 70% of the time up or down 1% a day, just like the S&P. Most of the talking heads on CNBC say gold's more volatile, but they're wrong. And over 10 days, it's only 3%. So the same. But gold stocks have twice the volatility over 10 days and twice over 1 day. So that means whenever gold stocks are up more than 2%, like 4%, 5% in a day, that means you could easily get a correction the next day, but it can be modest in a rising trend or vice versa falling. Crypto is much more volatile. Like Tesla, it's an emergent industry. Gold's been around for thousands of years. Technology is very recent. And so HIVE gets us additional volatility. The battle of media narratives, gold versus Bitcoin. Will crypto replace gold as the go-to inflation hedge in 2021? You just hear it, and I want to explain to you that I believe, in my experience, is that gold investors really are trying to protect a portfolio. Crypto investors are all trying to get rich quickly. That is the fundamental difference. But they both read from the same Old Testament of government money printing and government trying to take away your individual rights. And this has been a big issue, as you know, in the past year, particularly in Canada during COVID. What happened with Justin Trudeau, taking away the right to freedom of assembly, that is freedom of people to come to protest. You can't do that. The freedom of the media to cover a protest. It's just unheard of in America. And there are big differences. So you want to really understand it's a centralist argument versus a decentralist argument. And there's been many things that have been happening in business, which is decentralization, such as Uber comes along and changes the whole dynamics of cars on the road, cars driving people around, which was always controlled by one or two companies in every city, is all of a sudden everyone can take their private property, their car, and they can go out and drive and they can make money. And the high probability is that that Uber car is cleaner because someone takes ownership and owning it. This is this whole debate on private property. So we can see these two characters. Peter Schiff is famous for being bombastic, and he's a gold maxi. And Michael Saylor, the billionaire, that is a clearly digital media individual that is pro Bitcoin mining everything. He's made a substantial bet on it, and he's extremely articulate. In 2012, he said, put all your money into Apple, and that was a major home run. So he's a very smart guy. They both are worried about government money printing and the confiscation of your property rights. So let's look at some of the similarities between gold and Bitcoin. Both are rare resources. Both are difficult to corrupt. Both are liquid globally. Both are decentralized assets, and both are used for collateral. Now, regulation and the regulatory debate for crypto is the CFTC, the Commodity Futures Trading Commission, has launched two futures market, one for Bitcoin and one for Ethereum. And basically it's treated as a digital asset because it's proof of work. Very important concept. Proof of work means that you have to go buy mining equipment. It's different than gold mining, but you have to go buy hardcore equipment. And then you have to go and consume electricity. And rather than separate gold from the dirt with a refinery, et cetera, you create a gold bar. In crypto, you need to have electricity to unlock a digital asset and to create a unique digital asset. Now, the SEC is going after Ripple, and it's for a proof of stake, which they believe is a digital security. And a lot of these tokens are really another forms of securities that alarmed a lot of people that are buying these new coins and tokens when really there was no compliance, there was no corporate governance. And I think that was a great concern that the regulatory world had. So the difference between gold and Bitcoin, asset type, classification, the similar commodities, supply of gold is unknown. Now, it's interesting is that supply of mines is starting to shrink, but Bitcoin, everyone knows, is 21 million coins and 90 million have been already mined. So it's really fascinating that if you stop the supply of something and more people believe in it, then the price grows exponentially. It's called Metcalfe's law. I've done videos on this, a 2-minute video. You can go to Hive's website and you can watch this to understand it. But if gold ever turned around and there was a cap on the price of gold, supply coming out of mines, I think you could easily see gold at $100,000, $200,000 an ounce. History, gold is centuries. Bitcoin is new. It is definitely new technology. And then you can see regulations. There are some restrictions, but it depends on country by country with Bitcoin. Both are assets protection from fiat money and portable wealth. Gold is based on the fear and love trade. Crypto is the greed tech trade, is the way I've looked at to understand it. It's much more risky, as you can see the volatility. And it's important to recognize it's very much junior exploration on a sniff of a good property. Only 1 in 2,000 properties can find something that's meaningful, and doesn't mean it's going to be commercially viable. That's 1 in 2,000 properties. That means you're speculating, and that's recognizing that crypto is speculating. Now, how many remember during that lockdown, we were all binging on Netflix? One of the great Netflix, and if you haven't watched it, I highly recommend it, is the Medici story. The 14th century Medici, they invented double entry accounting. And this funding, this created a banking system which allowed middle class to be created, because before it was the haves and have-nots, and there was no way to turn around and build a business. They also created a bond market. They created letters of credit, banking system, and holding companies that we use to this day. So double entry accounting is very important for the evolution. And now Bitcoin is basically using blockchain, which is triple entry accounting. So triple entry accounting is understanding this importance of the blockchain is peer-to-peer transparency. When the trade was made, how much is trade, where, but the names are protected by encryption. That's what's special and unique. Interesting enough, this was created by the NSA in America, this idea of encryption. And if you look at your iPhone, you'll see that facial recognition is SHA-256. So it's very similar. It's the same encryption, except for Bitcoin loops it twice. Now, when we come to gold and crypto, they're bearer assets. A bearer instrument is a type of security in which no ownership information is recorded, like cash in your pocket. So cash is still, it's a physical asset. Used to be able to have bearer bonds until 1982 when they became illegal. So gold in your wrist, you can take off 24-karat gold jewelry. That's what the women in Syria did to get out of Syria during the crisis. The boat people in Vietnam, they had a gold tail, a gram of gold. They took their gold rings off, etc., and they used that as wealth. So it's a portable wealth. And along comes Bitcoin, which is the digital asset. And there's an important demographic reason why this has evolved. I'll share with you in a few minutes. So expanding the trust model. Money is about trust and about portability to it. And that trust creates a value. If the people do not trust the government that's behind that money, then all of a sudden that currency explodes. That is, take a look at in the past year, Lebanon. Take a look at in the past couple of years, Venezuela, and under the pressure of Turkey, where people do not trust holding cash for very long because of just the erosion with fiat money by government central bankers. So this is a very important concept to understand gold and Bitcoin and cash and versus credit cards and Visa and central banks. Visa, everything gets cleared by one bank, basically. Central banks are centralized. Well, what we're dealing in the crypto world is something that's decentralized. And the same thing with gold, that's decentralized, and the same thing with cash. I've advocated that the two can be inclusive, not exclusive. I've advocated the 10% golden rule and 2 to 5% in blockchain companies or crypto. As we can see here, Bitcoin and gold at a glance and price movements since 2009, when Bitcoin basically gets launched, Bitcoin has gone up an exponential number, whereas gold has doubled. The GATA group will tell you that gold is oppressed and suppressed by central bankers. And now the Bitcoin using the futures market will say the same thing. But what's really important is that these portable assets over time will appreciate and they will protect investors against inflation. Now, what's interesting for those that follow the crypto mining assets and Bitcoin is the correlation with technology stocks is 93%. The big NASDAQ tech stocks, it's incredible when you take a look at this correlation. And the crypto mining stocks are also correlate this number with Bitcoin, just like gold stocks are correlated with bullion. 93% of the time, 95% of the time, gold stocks go up and down by the hour with the gold movement during the day. So what's important to recognize when it comes to the world of gold and centuries of being used is the great love trade versus the fear trade. And the great love trade is that countries that believe in gold have gold in their vaults. They also, the people believe in gold for their families. And in particular in India, Indian women and how much they use to protect it. And the same thing happens in Turkey. The leader of Turkey keeps asking the people that he'll let you borrow against the gold, but he's just trying to get everything, his hands on their gold. They refuse to give it up unless there's a real financial crisis or a healthcare crisis. Will they give up their gold jewelry? What we have seen in 30 years is that this love trade is now about 60% of gold demand is for love, and that is highly correlated to the rising GDP per capita in China and India. The fact that China and India, affectionately known as Chindia, is seeing their GDP growth go up exponentially in the past 30 years. They've gone from consuming 4% of the world's gold to 55% those two countries. So when it comes to the fear trade, it's government policies. And government policies bifurcate either to monetary or fiscal. Monetary are real interest rates, that is, interest rates you're earning above the inflationary rate, and money supply. Interesting enough, I tell everyone, get a mortgage if you can, even at these prices. Why? Because inflation is greatly understated and inflation is much higher. And right now, mortgages are still 50% cheaper than the real CPI number, and it's not going away. I believe that climate change policies, especially out of Europe, are so out of step, and they've created this sort of systemic secular rise in inflation, and it's not going away. So now we have fiscal policies of tax and regulation and spending, and there's this big debate between the two. So let's come to take a look at the total global debt surpassed $300 trillion. A year ago, the end of March, the Federal Reserve has estimated that they made $188 billion with negative real interest rate bonds being floated in the marketplace and the bonds being pushed down. This year is totally different. It's a $500 billion loss they're going to have to book. And same thing in Europe. So that is a big, important part of looking at the sort of concern globally and what will governments do. What governments have been doing since 2001 is to practice the G20 finance ministers' MMT, modern monetary theory, that is using printing of money to solve every problem. Just print more money, and eventually real assets start to outperform. And we've seen spot gold far outperform this century the S&P 500. Technology stocks still have far outperformed the S&P as overall. So, and gold has done its job as a conservative investment. Now, the other data point that the media doesn't tell you is over the past 20 years, 80% of the time, gold has been up. In fact, in 2021, the average price for gold was positive because people looked at the beginning and the end of the year, two data points is, oh, gold was down, bad investment. When in fact, gold mining companies realized a positive number. So I really think it's important for investors that gold has been an exceptional asset class. And Indian women know this, that's why they wear 6 times more gold that's in Fort Knox, and it's protected them, their currency in the past year of being devalued. So you can see gold prices in rupee terms. This is an important technology timeline. The first email was in 71. The internet introduced in 71 was the first email that they could create. It was done by the US government, by DARPA, NSA Investments. And then they released the internet to the public in 91. In 91, blockchain was created. It was created by telecom to move money. And it was triple entry accounting, but it was never really embraced really until 2000. In like 98, Nick Szabo came out with Gold. But really, to take a look at it, in 2009 was the release of the blockchain using Bitcoin. And what this did was validate the importance of blockchain. And now it's a huge booming business. Next week or this week is Consensus in Austin. 15,000 people paying $1,000 a ticket. $15,000. $1,000. This is really important to grasp. This ecosystem is big. The Bitcoin event earlier this year in Miami was 30,000 people at $2,000 a ticket. MMT was created, basically used and starting in 92 at the same time of blockchain, but really didn't start being practiced by the finance ministers until, and the central bankers until 2001, 2002. So you can see in this timeline, it's important how fast the adoption of Bitcoin. So is Bitcoin an alternative to fiat money? It is an important alternative. But more important for me is always you have to be able to have gold. And I'm a big believer that you have a 10% weighting. But Bitcoin is the internet of digital money. It's full control. There's no middleman. It's programmable. It's open to all. It's limited in the supply. How does it work? Well, every 10 minutes, there is an opportunity, like a drop puck. And if your stick can touch the puck, and that is you can figure out the encryption and validate a transaction, you can get a new Bitcoin. And that Bitcoin has never been in cyberspace. And that means 900 coins a day are being created. And every 4 years, that number has been halving and halving. Out of the 21 million coins that have been mined, 19 million have been mined. So most of the crypto mining, those coins are in the marketplace. Now, I'm asked by vintage of my age, I try to explain to them that if you limit supply and you create demand, prices grow exponentially. And this was done by De Beers with diamonds. In 37, they had an epic discovery in South Africa. Then in 47, they went to Madison Avenue, New York City. They hired Ayers & Co. marketing department that all of a sudden started taking this thing called love, the intangible emotions and feelings of love, but it had to be validated with this tetrahedral carbon shape that's a diamond, the hardest substance on earth. And the only way you had something was called tangible was not a gold, it was a diamond. And it was held on a gold ring. But it's interesting and fascinating that it was less than 5% of Americans were getting married with a diamond. And after marketing and limiting supply, it's now, you were talking 80% of Americans expect a diamond ring for validating a commitment to get married for this intangible feeling of love. De Beers did it all over in the 60s in Japan, starting once again less than 3%. And 50 years later, 80% of Japanese women expect a diamond ring to show commitment to get married. China is slowly evolving, and it's not been around for a total of 50 years, but it's expected that it will be. The adoption continues even with all the negative news. Hydro against Bitcoin, Hydro-Quebec with their mixed messages. It doesn't matter. The banks are all trading it. We can see that last week, Gucci, Tag, and you can see other great luxury, very expensive goods accepting it. Interesting enough, the president of the central bank for the EU is known for all of our luxury goods and says that they're using too much energy. It's what's called FUD. It's false. It creates uncertainty and doubt. It's now been well documented that crypto mining consumes very little electricity. It consumes less than the gold mining industry. But people like her want to control all the money and control every cent that everyone has, and they're coming to come out with their own digital currency. Turns around 4 years ago, she said it's great technology, and now all of a sudden it's FUD from her lips. But what was the big breakthrough? It was PayPal. PayPal allowing you can't buy a gold stock, you can't buy a crypto stock, you can't buy an ETF on PayPal, but you can buy Bitcoin, Ethereum. And as they took off in price, you could convert it to go buy a TV. So all the millennials were the early adopters using PayPal. And then we saw Robinhood with 20% of their profits were coming from crypto and the following with it. So there is this incredible adoption that's taking place. I grew up with Monopoly money. I grew up with playing this game, but crypto kids play something different. They play Fortnite, Minecraft, Roblox. And if you're very good at these games, you get digital money in those different games, and you can upgrade. And then you turn around and gamers are part of the crypto ecosystem. There's 30 million of them that are out there mining Ethereum as a hobby. They don't play with Monopoly money, they're mining Ethereum. And so you see here this visual where you can get up to 30,000 people coming out on this sort of crypto event of digital gaming. The other big part is just the top 100 blockchain influencers. We don't have this for gold. There is nothing like it for the junior mining. Who is the most important influencers? And you can see here that Sam Bankman-Fried, this is a kid 30 years old worth 40 billion in the crypto space. And so you must appreciate something big is happening and how they communicate. Gold mining versus Bitcoin, they both need equipment, they both need energy. And here's a classic why I love gold mining, and I love particularly the royalty companies, is the largest single deposit area is Nevada, where Barrick and Newmont basically are doing a joint venture on the mining. But what would you rather own? Franco-Nevada, which has the royalties on their deposits, and they enjoy $37 million of revenue per employee, or Barrick with $800,000 of revenue per employee. So I always preferred the royalty companies, and Franco-Nevada was the first company, in fact, I was ever involved with as an IPO as a young investment banker in Canada in the early 80s. I was also an early seed shareholder of the creation of Wheaton, which does 35 million in revenue per employee, and Royal Gold does 24 million. So Pierre Lassonde out of Quebec, the most brilliant gold mining analysts out there that created the GLD, now a phenomenal philanthropist throughout Canada. This concept of the gold royalty business with Seymour Schulich was a phenomenal part of what I've looked at as investing. And here's a classic example of the gold royalty business. Franco-Nevada went private in 2020, then went public again in 2008. And since 2008, if you take a look at it, it's far outperformed gold and Berkshire Hathaway. So it's been an incredible asset. But since 2020, gold has outperformed not Franco-Nevada, but has outperformed Berkshire Hathaway. So gold is a very important part of a core asset class. And when it comes to the gold mining industry, I love the royalty companies. And so I created an ETF listed on the New York Stock Exchange, GoAU, the combined of these three gold royalty companies 10% each of them. They rebalance every quarter. Is 54 billion. That's myself looking at a copper gold deposit in BC, holding a beautiful brick of gold in Switzerland, and launching GoAU. And what we found in our analysis of 10,000 hours that focus on profit margin, focus on revenue per share growth, cash flow per share growth, free cash flow yield, and the gold royalty companies do a phenomenal job. And what for the other 70%, we pick those gold stocks which have these factors to them. They have the strongest growth. And so I just highly recommend that you can take a look at this quant approach. When you're looking at junior mining companies, it's reserves per share. Those companies in a rising gold market, we've done all this analysis in the junior companies in Canada that have the highest reserves per share, they have the biggest bang on the buck on the upside. What's happened with the GDXJ has been so crazy many mergers that they dilute the reserves per share, they dilute the cash flow and the production per share. So these mergers like Goldfields and Yamana, it's great for Yamana shareholders, but the combined entity, it's actually dilutive. So therefore, the overall Goldfields falls dramatically. It takes time. We saw this with a Cisco buying a junior mining company. They devalued the values on a reserves per share and cash flow. Immediately the stock gets hit because quant funds are in here. Quant funds quickly calibrate these stocks. And so once they finally get the reserves per share, the cash flow and production, then the Cisco's all of a sudden go through a beautiful re-rating and take off on the upside with rising gold prices. So this model does outperform the S&P year to date. It's outperformed since I launched it. Having a 10% rating and rebalancing each year is just a prudent process. This is comparing the GDXJ and rebalancing. As you can see, this approach does win. And what I've noticed now is that the junior gold mining is now buying more royalty companies because it is a superior business model. And with that, I saw growth in the opportunity. I couldn't launch a Bitcoin ETF, so I launched with friends in Canada the first crypto mining company. We mine, we create a virgin coin, never been in cyberspace, so it does not have a money laundering problem. And it's been an incredible ride. And we are mining, we're green only, and we are mining in Quebec. And what we've done, I'm so proud on Lachute, is take a 40,000 square foot building, as you can see, and we're heating a 200,000 square foot building, which is the biggest company in making pools, the Trevi Pool Manufacturing Company. And so we're doing this in other places. So we're able to recycle the energy to create heat. Hive blockchain is extremely oversold. This is to give you a contrarian opinion, along with Bitcoin, because they correlate. And there's time for a high probability for mean reversion. There's no extreme oversold for gold and gold stocks, but gold and gold stocks are on a secular uptrending move. And I remain very bullish on both. And I wish you nothing but happy investing and great speculation in the gold mining industry. Thank you very much, ladies and gentlemen.
Thank you. Thank you, Frank.